DocuSign is the leader in digital signature capture software, and their solution is in many different industries. If you go into certain industries, they just dominate. It's just been something that they've taken over, and it's going to be really hard to replace them. It just, when we got into COVID, especially, a lot of industries really pushed away from paper and over to having everything digitized. Really good idea. So DocuSign finds itself being integrated to a lot of different software platforms and within a lot of industries. That's all good for DocuSign. They announced their earnings today after the market closed, and their earnings were positive. I just read through their earnings, and my general impression is it was positive. Here's what I wanted to share. Revenue, it's growing well. They grew year over year in quarter. They grew revenue by 9%. That's very good. The overall profitability of the company has gotten better, and they expanded free cash flows more than I expected. So a healthier amount of free cash flow. Financials look really good. The company is really healthy. This is a really attractive acquisition for a larger company. Cash flow looks excellent. It grew 36% yield of cash flow in the most recent quarter. Good to see that cash flow is expanding for the company. All the other metrics, just a very well-run company. Guidance. As we look at full year guidance, they expect to continue to grow. High single-digit growth. High gross margins, 80 to 81.5 gross margins. And that's going to drive that really good free cash flow. So overall, the earnings were positive for DocuSign, and let's see what the market has to say about it. Let's look at fundamentals. So today is March 13th. It was a bloody red day on Wall Street. A lot of stocks were just really sold off. DocuSign was one of them. A lot of software companies just were sold off, and their stock was sold off by 6.8%. In after hours, the stocks regained close to 6%. That's really encouraging. Year to date, the stock's down 17, primarily because there's been a bear market that we've seen in 2025. But over the 1 year, it's still a really good stock, 27%, even though it's had a really strong pullback. So DocuSign is only a $15 billion market cap company, almost $3 billion in revenue. So you're paying about 5 times revenue. Not bad for a growing, highly profitable software company. Their forward PE is 20.5, and analysts think highly of the company and think it's being discounted by 26%. The consistent growth that DocuSign has had has made it a really nice sized company, almost $3 billion, with very good profitability. The profitability, gross margins at 80%. Free cash flows are really high. All those things make them a really valuable business. And again, I think they could be acquired. This is just a really attractive business. Their balance sheet is solid, with the company having $942 million of cash and debt of only $130 million. So they have net cash balance of $811 million, and they're generating more free cash flow. So just a really strong business. 11 analysts cover the stock, and the most optimistic analyst has a price target of $124, and the most bearish analyst is only at 68, which isn't too bad of a downside. When we look at their revenue growth, it's expected they're going to grow high single digits, and they're now into their fiscal year 2026, which began February 1st, 2025. Their earnings per share will expand and continue to expand into 26. I'm going to give them a P of 20. So those are their base fundamentals that I'm going to use in valuing DocuSign. So I value companies based on their free cash flows, how many cash flows they're going to produce in the future, and then discount those cash flows to today's value. For DocuSign, those cash flows did expand, and I updated those numbers in this particular forecast. I'm going to grow each year in the first 4 years by just 5%. It's a little conservative. And then in terminal value, I'll grow it by 4%. The discount rate I'll use to discount all those cash flows to today's value is 8%. And I get a net present value of $23.2 billion. I add cash and take away debt. I get to an equity value for the company of 24 billion, but their market cap's only 15 at this time. So if I compare the value of all those cash flows to the current stock price, there's a 57% discount available on DocuSign. The earnings per share, I think, is close to fair price. It's discounted by 7% based on the criteria that I'm using based on earnings per share. I blend these two numbers, but I put more weight in the free cash flow number. I go 2/3 free cash flow, and I get to a blended amount of 40%. 40% discount on a stock that is really valuable growing. So how desirable is DocuSign? Is it a highly desirable company or just somewhat desirable? Well, I really like DocuSign and believe that they have a strong moat. I think their competitive advantage in the digital capture market is clear. They have gotten market share. The changeover cost to businesses is pretty high. They have to reach their customers, their employees. So I think businesses that use DocuSign just don't want to change. And that creates a really nice moat. They're really profitable. They have good growth. So I think that DocuSign is in that desirable quadrant of a strong moat, high profits, high cash, and growing. That said, I'm going to continue to buy shares in DocuSign. It's a winner on my portfolio. With the recent pullbacks overall to the market, it discounts the stock, and I am gladly buying shares of DocuSign. So that's my video on DocuSign. Just a reminder, I'm an individual value investor. I do not recommend you buy, hold, or sell DocuSign. I'm just sharing my experience as an investor, and I'm not providing any financial advice. Please make your own decisions independent of what I'm doing. So thanks so much for watching, and good luck investing.